All right, today we are deconstructing the investment case for a company that you've probably never even heard of. It's called Brødrene and Johansen, but we're just going to call it AOJ. So let's get right into it.
Now, at first glance, this looks like a classic, maybe even forgettable industrial business. I mean, it's a Danish company that's been around for over a century, supplying stuff for the construction industry. And get this, it's still controlled by the Johansen family that founded it way back when.
Exactly. Your first thought is probably slow growth, gets crushed in a downturn, the kind of stock an investor might just scroll right past without a second thought.
Well, that's the million-dollar question, isn't it? Because despite its age, despite its boring industry, one investment report is screaming buy. That suggests the market might be missing something big. So let's dig in and figure out what's really going on under the hood here.
It turns out the secret to AOJ isn't its 100-year history. No, it's an incredibly modern and aggressive strategy. They're building what investors love to call a competitive moat, but not with bricks and mortar. They're building it with data, with code, and with automation.
And this whole strategy really stands on three key pillars. First, an obsession with being the digital leader in an industry that's, well, let's just say it's been a little slow to adopt tech. Second, they've poured money into creating mind-blowing logistical efficiency through automation. And third, they take the cash that their core business spits out and use it to make really smart, targeted acquisitions.
And look, this isn't just talk. You can see the strategy in action. This isn't random. It's a methodical push into new areas like online retail and new countries. But check out this move for 2026. They didn't buy the stores of this competitor, vvexpertin.dk. They just bought its popular web address. Think about that. They're essentially plugging a well-known online brand directly into their own super-efficient delivery machine. That is a pure 21st century digital play.
Okay, so a great strategy on a PowerPoint slide is one thing. But the real test, the only test that matters for an investor, is how it holds up when things get tough. So, how did this so-called digital moat actually perform during the recent economic mess?
Well, the numbers speak for themselves. In a really difficult year, its main competitor, Solar, saw its sales drop by more than 6%. But AOJ, they actually grew. They grew by over 3%. This wasn't just about surviving. It was about taking ground while everyone else was retreating. And it's not just us saying that. The company put it in black and white in their annual report, stating that they actively gained market share. It seems that when budgets get tight, customers flock to AOJ's efficiency and reliability. That's proof that the model is working. But here's where we have to ask the tough questions. If the strategy is so solid and the performance is so strong, what's the catch? There's always a catch, right? Well, a big piece of the puzzle is hidden in how the company is owned and controlled.
See, through a special type of stock with super voting rights, the founding Johansen family controls almost 72% of the votes. Let that sink in. For you, the public shareholder, that means your power to influence the company's direction is, well, it's pretty much zero.
So this is the big trade-off you have to accept. The risk is obvious. You have no say. But there's a flip side, a potential reward. You get a management team, led by a family CEO that thinks in decades, not in quarters. This is what's allowed them to make huge, long-term bets, like fully automating their central warehouse, a move that a typical CEO, worried about the next earnings call, might never have the guts to make.
Okay, let's pull this all together. It's time to lay out the final arguments, the bull case versus the bear case for investing in AOJ.
The bull case is pretty compelling. You've got this durable digital moat, you've got hard proof that it works in a downturn, you've got a clear roadmap for growth, and it's all being driven by a skilled management team that has its own skin in the game for the long, long haul. But the risks, the bear case, are just as real. At the end of the day, this business is tied to the boom and bust cycle of construction. There's a new, much bigger competitor making moves in their territory. And you can never, ever forget that as a public shareholder, you're basically just a passenger on this ride.
So after you weigh all the good against the bad, what does it all mean for the stock price? What is the market actually paying for this company today, and what could it be worth down the road?
And this is where it gets really interesting for an investor. Right now, AOJ trades at a cheaper valuation, a lower price-to-earnings multiple than its weaker competitor, Solar. The argument is simple. The market is still pricing AOJ like that boring, old economy company, not the digital-first powerhouse it's actually becoming.
So, if the bulls are right and the market starts to wake up and recognize this transformation, what's the potential upside? Well, the analyst who recommended that buy put a 3-year price target on the stock of 135 Danish kroner. Now that implies a pretty significant return from where it is today.
And that really leaves us with the ultimate question. For its first century, AOJ's moat was built on physical warehouses and trucks. For its next century, it's betting everything on a digital and logistical moat. And for any long-term investor, you have to ask yourself, is that new moat strong enough to last?